Was $75 the real bottom? Or just a pause before another leg down? And more importantly, what comes next? Is the next target 95? Do we retest $75? Should you hold silver, sell into the bounce, or rotate into gold instead? Because this reversal wasn't random, it was structural. And if you understand why silver bounced at $75, you'll understand what likely happens next. Let's break it down step by step. What the $75 reversal really means first, let's be clear. A violent reversal after a crash of that magnitude is not normal market behavior. That wasn't retail dip buying. That wasn't hype. That was institutional demand stepping in. Why? Because $75 triggered multiple forces at once. Extreme technical oversold conditions, massive short covering, physical demand, absorbing supply, paper selling exhaustion, and most importantly, leverage had already been flushed. By the time silver hit $75, the forced sellers were gone. Margin calls were done. Weak hands were out. That's when markets stop falling. Not when news improves, but when sellers are exhausted. And that's exactly what we saw. Technical structure. After the reversal. Now, let's talk levels, because structure matters. Silver reversing from $75 creates what we call a classic capitulation low. Historically, when silver prints this kind of move, the next phase is not a straight line up. It's a rebuilding phase. Here are the key zones. $75, major cycle low and psychological floor $80. First resistance zone, initial bounce area, 86-88. Breakdown retest zone, $95. Major decision level, 188. 115's full trend recovery zone. If silver holds above $80, that's constructive. If it reclaims $86 to $88, the market starts accepting that this was liquidation, not a trend change. If it reclaims $95, the entire bearish narrative collapses. Why silver bounced harder than gold? Now here's where confusion starts. Silver bounced harder than gold. That's not an accident. Silver always moves more violently at turning points because it's smaller, it's thinner, it's more leveraged, and it was more oversold. Gold is stability. Silver is torque. After crashes, silver usually leads the recovery. That doesn't mean gold is weak. It means silver was crushed disproportionately, and it's playing catch-up. Should you hold silver? This depends on who you are. Let's break it into 3 categories. 1. Physical holders. If you hold physical silver long-term, nothing structurally changed. You didn't buy silver for a 10% move. You bought it because fiat systems are strained, debt is unsustainable, physical metal is finite. Crashes like $75 are transfers of metal, not warnings. Historically, selling physical silver after capitulation reversals has been a losing move. 2. Swing traders. If you're trading silver, risk-reward flipped at $75. Shorting down there made no sense. Chasing aggressively now is dangerous. What matters? Higher lows above $80. If $75 breaks again, the bounce is invalidated. Simple. 3. Leveraged traders. If you're using leverage, this market is still hostile. Volatility is extreme. Whipsaws are violent. Risk management matters more than direction. This is not a forgiving environment. Should you rotate into gold? Great question. Gold and silver serve different roles. Gold, monetary insurance, slower, more stable. Silver, monetary plus, industrial, more volatile, outperforms during reflation. Even after the bounce, the gold-silver ratio remains elevated. That means silver is still historically cheap relative to gold. Rotating fully into gold after silver crashes and rebounds is usually poor timing. Balanced allocation historically performs better. What could go wrong? Let's talk downside risks. Broader risk-off continues, dollar spikes again, real yields push higher, liquidity tightens. If that happens, silver could retest $75. That doesn't automatically break the thesis. But it does mean volatility isn't finished. Markets don't heal overnight. What drives the next leg up? On the upside, catalysts include central bank policy shifts, liquidity injections, dollar weakness, visible physical shortages, industrial demand stabilization. Silver doesn't need all of these. It needs one, because positioning is already light, leverage is flushed, sentiment is broken, and that's often when markets turn. Big picture projection. Zoom out. Silver at $75 wasn't failure, it was a stress test. Paper leverage collapsed, physical demand held firm. That divergence matters. If silver were truly unwanted, it wouldn't have snapped back violently. It would have drifted lower quietly. Instead, it absorbed supply. That's not weakness, that's accumulation. Final takeaways. Read this carefully. $75 is a major reference. Low holding above $80 is constructive reclaiming. 86 to 88 shifts sentiment. $95 flips the trend. Silver is no longer in free fall. It's in discovery mode. What you do now should not be based on fear or relief. It should be based on structure, time horizon, and risk tolerance. Crashes shake people out. Reversals test conviction. The worst decisions are made in the confusion after. Stay disciplined. Stay unemotional. This market isn't done. It's resetting.